Welcome back to the Property Trio, the podcast for the sophisticated property buyer. Today we're unpacking the 2026 budget, what it actually means for property investors, homeowners and renters over the next few years. There's been a lot of noise since the changes were announced, plenty of speculation and not a lot of clarity. So we're going to cut through it today. We'll get into where prices are heading, what happens to rents and yields, whether investors are more likely to sell or hold, and what it all means if you're trying to make a property decision right now. So Dave and Mike, got an exciting one in front of us. Let's get into it.
We'll add
Looking
to the
forward
noise.
to it.
Absolutely. Well, first question, based on everything we're seeing, what's your headline prediction for how these tax changes play out over the next few years? Dave, I'll start with you.
Yeah, look, firstly, before we get into the predictions, it's worth saying that the biggest constraints on housing in Australia is a lack of supply. And this lack of supply is caused by excessive red tape, bureaucracy around what can and cannot be built, planning delays, infrastructure bottlenecks, labour shortages and costs, the costs of materials and the taxes and charges attached to building new housing. Together, they mean fewer new homes get built. But as we know, instead of tackling the structural supply issues, the governments keep reaching for demand-side policies like providing cash, waivers and cost savings for first-time buyers that boost demand and push up prices while taxing property investors more heavily. And really, that's the backdrop for everything else we're about to talk through. And, the tax changes are just another example of this type of approach, potentially the worst kind of example. So in terms of where prices actually go, we think they've already fallen probably 5 to 10% in many locations across the country. And the data just lags behind the reality and takes some months to reflect this. So today's buyers and those in spring will already see opportunity. Rents, in the meantime, are going to keep rising. And look, that's at the current rate, which is around 6% per annum, which is well above inflation, and maybe they'll rise more. So as such, yields are really going to grow. And I think they could, as I've mentioned a couple of times on the podcast, could jump by up to 2% above where they were at prior to the budget over the next 1 to 2 years. This will recalibrate the metrics of investing in residential property so the numbers make sense again. And this is when a floor forms underneath prices. I think, look, the largest falls in history in residential property on a national scale have been around 8 to 11%. So I expect we'll see an overall reduction around these types of levels this time again. I think buyers will come back in greater numbers at some point in 2027. And I think this will be as soon as we see the data for 2 to 3 months showing inflation is falling, which I think will happen in the next 6 to 9 months, which will be the catalyst for mainstream property buyers to get and investors to get back en masse. Because my major takeout is that the economic fallout from these tax changes is going to be much more widespread than most people expect. And this is going to slowly play out over the back half of this year. The financial review is, and a number of like the economists, the investment managers, etc., starting to talk around this. There's articles popping up along these lines now. And I think once rate rises are off the table and yields have risen by 0.5 to 1%, but with further to go, I think that's when the smart money and early movers will return. And I think some are already taking action. But yeah, that's why we think this period of falling prices, buying the dip, because this period of the next 6 months, maybe longer, offers one of the best windows to buy quality and most likely established property. But, there still are some new properties that may pay off over the longer term.
So you haven't thought about it at all, Dave?
I've thought about this a lot, Mike.
Totally.
I've got, extensive blog on my thoughts as well.
What's really interesting, and you talked about some data at the start, Dave, nationally, our steepest fall in the last 40 years hasn't been 9% nationally. So obviously you've got states and capital cities that do better and worse than each other. But to put it into perspective, there's a really good chart, and I'll put that in the show notes. We've used it a few times of late for that very reason, just to apply perspective. But I think there are a lot of what ifs here, because there's potential for change, and these are legislated changes that have triggered this. We've had rising interest rates and the threat of inflation and global issues, relating to what's going on overseas, not just in Iran. We've also got conflict in Russia and Ukraine, which it's created a lot of problems globally in all kinds of sectors. But the critical one is the legislative change. We can argue that things were already challenging in some of our capital cities and locations around Australia in the property market because of the other headwinds, but this has definitely shaken things up, and it's created a lot of upheaval for people based on sentiment as well.
Yeah.
But like switching on a tap, it can be switched off as well. And you've got people out there that are talking about changes or whether it could be repealed when the opposition could come into power, if and when that happens. So change is always imminent. It's just a question of what does the runway look like? Are we stuck with this for another 2 years? Are we stuck with it for another 6 years? We don't know that. And there will always be conversations out there that will give people the incentive to jump in now or to sit and wait. Some people are being bold and they're looking at jumping in now. And something that I also want to add is when we do have these shocks, we tend to find that our price falls occur quickly. It's not like it keeps falling at a rate of knots. The shock hits everyone. The prices drop reasonably quickly at the start of a change, and then it starts to slowly return to normal, and then do its thing when we have another run.
Yeah, and as I just mentioned, that's already happened in many and most locations, really, but it just doesn't show up in the data, that the indexes and indices that are posted in the newspapers and online.
Yeah, absolutely. I mean, we can anecdotally talk to that as people on the ground. You're seeing sales contracts and pricing, you're getting bank values back. I'm bidding and negotiating on properties. The first 3 weeks were the harshest. We saw the biggest price falls then and saw the biggest opportunity and, the most in pain vendors, I guess I can say. And since then, the price falls haven't continued at that rate at all. In fact, it feels like it's kind of tapered off and levelled.
Yeah, and because vendors will only give up so much. Otherwise, they take their properties off the market. They sell later. We're seeing that in auctions, because now a big stat with auction clearances is how many auctions were pulled prior to the date of the auction, how many were sold in advance. So vendors can make decisions not to sell. Not everyone's in that position to do that, but enough of a percentage are that then go, look, I'm not taking, because you can just compare, the sale price of a property that sold on the weekend to ones that were selling a month or two ago versus 2 or 3 years ago. And doesn't take much. Anyone really can calibrate what's already happening in their local suburb or, on the ground. And so vendors know that and then go, look, I'm not willing to take a price hit of more than X and whatever they had in their mind, but that's 5 or 10% or whatever. And so they don't sell. So that, that's part of what can play out and does play out in these times in property markets.
Yeah, absolutely. Before we move on to the next question, Mike, what's your thought on how the tax changes play out over the next few years on property prices?
Well, my biggest prediction is that our 2026 predictions will be wrong, but it's not our fault because the Prime Minister promised that he wouldn't change the tax legislation around negative gearing and CGT. So, I mean, were we foolish to take him on his word? I mean,
we were.
Obviously we were, but at the time it kind of seemed like a fairly big promise. So obviously we will have biffed that one pretty hard. Look, I think my overall summary is that the tax changes won't solve the housing shortage. They'll just change investor behaviour. I think we'll see a big reduction in transactions. I think investors that are in grandfathered properties will lock those in. I think new demand will be directed, for better or worse, to new builds, and there'll be further pressure on the rental market. I'm thinking the Treasury modelling of $2 a week is at least going to be $35 a week increase in median rents across the nation. So that's me sort of sticking my neck out there, and we can go back and check on that later. But the central problem is still supply. Changing the tax treatment of investors doesn't create enough land, doesn't create more trades, it doesn't build infrastructure or completed dwellings. So I think what we will see in the future is that this was another 85, 87-esque housing punt that was a failure, and then it'll be another 40, 50 years before we try it again.
Yeah. Well, I've got a question for you again, Mike, that kind of hinges on what we talked about and covered in our last ep about renters and rents. So we know that renters are already doing it tough. What do you think happens to rental supply and yields from here, and how dire could it get?
Yeah, look, that is the big concern because we're talking about homelessness, really, in some respects. I think we'll see a big fall in investor transactions. I think somewhere around 30% reduction in investor transactions once we sort of see that data as a bit of an estimate. I wouldn't be surprised to see it drop 30 to 50%. So what will happen to yields? Like mathematically, I would say, if you think about supply and demand with economic principles, that rents would just go through the roof. But I think we saw in 24, 25, after the gains in 23 in rental growth, is that there's only so much that people can afford before they change their behaviour. So, look, as the rental pool contracts, I would say rents and gross yields are very, very likely to increase, but the rents can't just rise indefinitely. So people will change their behaviour. That'll be living with their parents for longer, if that's an option, taking on an additional flatmate or moving into share accommodation, forming households later, moving to cheaper or less convenient areas, or accepting smaller or lower quality housing. So, these are ways that I think this policy will hide the impact, right? Because it might not be a huge increase in rents, but the real harm in this policy is that people are living in situations that are suboptimal to what they want. But look, I think there'll be a practical ceiling on rental growth, but there'll be a decline in living standards and certainly a serious risk in increasing homelessness, particularly among the households that are already living on the edge. And then the big one on top of that is the interest rate. So I think we will see a rise before we see a cut.
Well, that all doesn't sound positive, but I absolutely agree with you about tenant displacement and household formation rates increasing. I think that's absolutely going to change because those systemic changes are a reaction to such a significant policy change. Dave, what are your thoughts?
Yeah, look, I think rental stock, it's already at historic lows and it's only going to get scarcer. Mike said the number of investment properties being purchased falling by 30 to 50%, and I'm sure he's done some reasonable modelling on that. Obviously, he sees the highest volume out of our three businesses going through in terms of a depreciation perspective. So that does not surprise me at all. And I think this is where the political backlash will hit hardest in the media. And it's a big reason we expect most of the tax changes to be amended or overturned at some point when we get a pro-business government in, and whether that's in the next next 2 to 6 years, as you've sort of touched on. I similar thinking, but obviously we, as you, Cate, but I think we can't rely on that to happen. But I do think wealthy people are for those who like to take larger investment risks, and that some people do, and you've got to follow what's right for your own investment strategy and risk profile. You can see them backing that property prices will rise again, rental yields are going to become, I think, quite attractive, and there's that potential for the legislation to adjust back. So therefore, punting on a recovery would suggest, that now in the next 6 to 12 months is going to be a really good time to buy. In terms of the actual rental increases, it's already at 5.9% per annum prior to these tax changes. And Mike's just used numbers about how fewer investment properties we're going to have, but there's still as many renters. So, I think this will get into 6% growth, 7% growth. As Mike said, people will make different decisions. But, I can see 6 or 7% growth lasting for a while.
Yield,
And
do you mean?
in terms of the actual cost of rent, which means then the yields, will increase by, if you're getting on average, at 3.5% or 4%, I think they'll go up by 1 to 2%. So yields will be looking, much higher than, and I think back to where they were 20, 30, or even 40 years ago.
Yeah.
And, that's the natural.
Like that 4 to 6%
4 to
band for
6.
houses and units.
Exactly. That's actually exactly where I think they'll end up.
And in a lower interest rate environment, that's a way more attractive holding pattern for an investor. I mean, you almost don't need your negative gearing benefit.
Yeah, 100%. So it naturally sort of, it's a natural adjustment mechanism, isn't it? Like, it's amazing how markets adjust, and then you don't need to hold a property for that long to become positively geared. So again, it changes the metrics, and people, there's a reason to invest, and it offsets the weaker, it offsets longer term weaker capital growth, like they've modelled. If capital growth on average, let's say it had historically been 6% for a long time, if it comes down to 4%, the yields offset that. So, but I also expect, and I think Mike might have mentioned this at some point one of you two in a podcast, but the government will, because what they're trying to do in some regards with property, obviously, is make it easier for first home buyers to buy, because prices aren't supposed to rise as rapidly. But it's going to make, as Mike in particular, is just so much harder for renters. And renters are often the future first home buyers. So, but I suspect then the government is going to throw some extra money at renters, which again will push up rents for people who buy investment properties.
And
so
inflation.
Again, and inflation, and that is the big worry with inflation, because I think it's one of the top couple elements in the inflation basket, rent. So, look, that's sort of, that's what I think.
Yeah. Mike, I want to chat about investors selling up. What data are you privy to? It's very difficult, and I know that Cotality and PropTrack will cut the data for us, and they get a reasonable read on investor-led sales, because obviously they're reliant on an algorithm that registers that a property that's for sale was advertised recently for rental. It has that commentary associated with previous listings. So it's not a perfect science, but you're probably closer to the perfect science than anyone else. What's your read on investor-led sales?
Yeah, we don't look at sales like in our business, right? We speak to people when they engage in a new investment property, and the first time we really started talking about ex-rentals or say rental sales was around about the time Queensland legislated their land tax changes. So I was showing that there was, I think, a 14 basis point reduction in investors purchasing in Queensland in the 98 days immediately subsequent to that, where they could have transacted in that period knowing that that was about to happen the following 1 July. And then we saw people like PropTrack looking at the other side of the equation, where I was saying there's less people coming in and there's actually more people going out. So I haven't looked at the data of that for quite a little while, and it's probably a little bit too soon to see too much of that. But there'll be two things at play, I think. We'll have less people coming in, but we might not necessarily see a lot of people leaving because of the grandfathering arrangement. So I think most investors who already own a grandfathered property will be more likely to hold. Of course, if it was their plan to sell down that asset anyway in this next little time period, they'll probably do that. I think there will probably be some people who don't understand the difference between a 50% CGT and an indexation model, and it all gets too hard for them and they're going to try and sell before 1 July. There's the intent of the legislation, and then there's the actual human behaviour, and they don't always match. But I think there will be also a large cohort of older investors who eventually do want to simplify their affairs or reduce their debt or retire. I mean, we have quite an overrepresented cohort of housing asset owners that are in their later stage of life. So I think some may decide to sell rather than transition into those indexation arrangements, regardless of whether they have fully modelled the consequences or not. So I think there will be fewer transactions for new people coming into the market. I think we will see a gradual flow of sales, and it just won't be replaced. So really the immediate response, I think, will be a hold rather than panic selling, because the grandfathering gives those existing owners a really good reason to stay put. So look, I think there will be just the normal sales that we would see anyway, maybe a few extra with fear of those new rules or having to get their assets valued by 1 July and understanding the indexation. So, remains to be seen, but that's what I think will happen.
Yeah, look, I think a couple of things will influence investors to sell, and we've got to look at the investment tenure and the runway. People typically don't plan to sell when they're doing this for the long term until they approach retirement and they want to simplify their life and reallocate their assets and not deal with the maintenance associated with property as well. And they might put money into super because they've got tax advantages at that age. But we'll see a few investors who are nervous about the impact of this on their asset values, saying, I'm bailing out of this now, getting out of the property asset class and putting it to something else, shares, whatever. And I think that onerous reforms on the rental side of things have already been gripping. We've seen that a lot in Victoria because it's just got very hard for a lot of investors. And for those who don't have the stamina, I'm not just talking about tax. I mean, land tax was a blow and it still is. But I'm also talking about all of the reforms and the minimum standards and the cost associated with bringing an older property up to speed. My biggest issue around investor-led sales is if we think about the older houses in the inner and middle ring pockets of our cities. Think about the share house that the uni students lived in because it was close to the city. Those are no more. You can't have a cheap rental property where you've got 5 students dealing with, subpar housing standards, enjoying it because it's $90 a week each. Those houses are now much more expensive because they've either been updated and the landlord spent money on it. It's a better house now. It gets a better rent. It's chopping out the students. Or they've just said, this is all too hard, or I haven't got the cash available to do these renovations, I'll just sell it. And so the tax settings that we're looking at now mean that property is highly unlikely to sell to another investor. It's most likely going to sell to an owner-occ. And so the displacement of those inner and middle ring the displacement of the inner and middle ring tenants is a big concern because they're established areas and we're not likely to attract very many investors at all unless it's able to be knocked over and new townhouses, high density builds taking place, and then they're selling to investors, but that's a very different type of housing.
Good point. Look, I think that obviously there'll be some investors who choose to get out because the market is falling, reducing in price. There will be some who choose to get out prior to the CGT tax legislation. But I think on the whole, we're going to have a structural change, which means even less properties are sold per annum relative to the number of properties in this country. And that's something that's already been occurring over the last decade because we've got data from different parties that the average time people hold on to their property has increased by about 3 to 4 years just over the last decade. And so this is and that you could say, look, that's probably because of the stamp duty impost. It might be also because people are more educated on the wealth they can grow through property. And these changes actually incentivize you to hold for longer. So if you hold, obviously there's the whole cohort who's got grandfathered negative gearing, number one. So if they hold it beyond the CGT changes, you think they're in it for the long haul to make the most of that grandfathering. You've then got the people who do buy established investment properties moving forward. Obviously, they want to soak up the losses and carry for the longer term. So they've got an incentive to hold for longer. Then you've also got, as I touched on recently, a third cohort of anyone who wants to turn an existing home into an investment property that could be negatively geared. So they've got an incentive to hold for the longer term as well. So this is all going to result in fewer established homes on the market. And as I've touched on, that's not a new trend. And as you've sort of alluded to there, Cate, I mean, we've got to all remember, like, so much of the commentaries around investors, but that's only 1/3 of the property market, and it's going to become less. 2/3 of the property market, 70% even, are owner occupiers. They don't care. They don't have any tax benefits in terms of able to claiming the interest, which is what we're talking about with negative gearing. So they're the main people who are buying property, and they're going to be competing for established properties. And that percentage of, is likely to go up because of these changes. So, I actually think it's going to have a reasonable hit on supply because the number of properties for sale per annum is proportionately is going to fall further, which has already been a trend over the last decade or longer.
Yeah. Well, I've got a question on that note. Let's talk about new buyers. We've chatted a lot about the impact on investors, and I think we can all answer this one. Mike, I'll start with you. What questions should a new buyer ask themselves?
Well, I feel like I might be treading on Dave's toes here, but start with strategy. I think like that matters more important than ever. Like, what are you trying to achieve? A first home buyer and an investor are making fundamentally different decisions. So I think, like, for an investor, what's the strategy? Do I understand the true numbers before and after tax? And, now after tax talks about the back end horizon when it becomes positively geared or when they sell it. Is it a quality property, or am I buying because of particular concessions? That's always a first home buyer thing. I think they need to consider, will I be able to afford it if rates go up, if there's vacancy, if they're an investor, or if expenses rise? I don't think vacancy is going to be a big problem for investors in the next little while. And will it appeal to owner occupiers when I eventually sell? That's I think where there's been a fundamental change. Dave was sort of saying, a third of transactions, or let's say 30% of transactions are investors. So the vast majority is owner occupier. I think we've seen in the last little while, once it gets over 40%, APRA get nervous and they jump in. But even at that particular height, the majority of transactions are from owner occupiers. So I think it's really important to consider, does this have owner occupier appeal? I think there's been a lot of investors that have made money just on the back of investors piling into locations, and they were there earlier, or they pre-existed in a location, and there's been some large volume buyers agents that see some fundamentals in that market and pile in. I think that won't really happen anymore in the same way. So I think we really do need to think about, like, who is the potential next owner of this property. So it's getting much more to the fundamentals of property investing that we've talked about for years and years. I think it's going to return to a much more traditional approach, less emphasis on the crowds and the hotspots, and more emphasis on the things that, Peter always talked about, buying good quality, well-located, blue-chip sort of assets that appeal to owner-occupiers. So I really think everyone needs to be starting with that strategy.
I agree, and I think the question was, what questions should a new buyer ask themselves? I think the one biggest question, now that we've got, a government that's steering us towards new builds for investors, and, this question is a new buyer, it could be a new investor or a new owner occupier, we have to ask about the risk associated with new. I mean, we have talked about diminished land to asset ratio and, settlement risk and, developer issues and all of the nasties that you can find in a badly built block or a high-rise development where margins are really high, something where due diligence is missing. But the biggest risk I see for buyers who do buy new is the value of that. The intrinsic value is pretty much tied up with the tax benefits that the first owner gets. After that property is secondhand, whether they've owned it for 6 months, 12 months, or 10 years, it hasn't got that same value. So what is the value decrease that buyer number two will experience? And we don't know exactly what that figure is. We haven't got the data yet because it's brand new policy, but there's got to be a diminishing value there as a result of missing that tax advantage. And unfortunately, the owner-occupier who buys brand new will pick up that same disadvantage. And something that really surprised me when I did a bit of digging a few months back when I wrote a blog was when it comes to first home buyers, nationally, the figure is slightly more than half buy brand new. So if you are looking at buying a brand new property, you're not only now competing with more investors, you're already competing with a cohort that see value in new, and it might be because they can put down a lesser deposit or because the settlement isn't for a while, or they just like
duty,
new and glossy,
government incentives.
Exactly. So there's a lot of reasons why a first home buyer will see a benefit buying brand new, but I think they have to look at the negative. And that negative, in my view, aside from all of the other things that I've listed about the risks of buying brand new, particularly high rise, is losing that intrinsic value once it's no longer brand new and it's secondhand.
Yeah, I think it's a really big point. And I think it's unfortunately when people buy dud properties, it's a slow moving train wreck, and the realizations don't often take place for 5 years, 7 years. Talked about this multiple times. It's not like you can see the share price on a day plummet by 50% or whatever. And not only when you start to see that happening, it still takes time for the individual or couple to process and accept that they've purchased a poor asset and hoping that it may recover, or there's some other reason that's causing it to perform poorly. So that is the big risk for so many people, I think, moving forward, because no doubt with these incentives, more are going to buy new, but this premium that therefore is going to ratchet up the price they pay up front, and then the cost that when it comes to selling, because the day after they settle on it, it's now an established property.
Yeah.
I think that is going to make for an interesting case study in the future around.
That's right. What is that cost differential on day two? Imagine if you bought something for, let's say, 800,000, and then you've decided, you know what, I don't want this investment property, I'm selling it. Well, it's only a day old, but what does it then? And I'm being a bit cheeky here because I'm sure that there are exceptions if someone hasn't physically moved in. But let's say it's been rented out and they've enjoyed 1 year of having the negative gearing benefit, and then the tenant decides to leave, and then the investor says, you know what, I'll sell it. And they get the vacate clean done and it looks sparkling and brand new. It's almost as good as the day that they moved in. How much less will that sell for? And that is a nasty case study, I think.
Yeah, and I think the reality is most people won't sell that quick. So the pain's actually going to be greater when they sell in 3 or 5 or 7 and try to, buy the stepping stone home, or which is often the case first home buyers if, their second purchase. So, but look, I've got a few questions and you probably touched on some of these. How much more am I paying compared with a similar established property in the same location? I think that's a really good piece of analysis for a buyer to do. How much additional debt does that create? And could it limit my ability to buy another property? what are the true holding costs with the new property versus an established one that's comparable? Does the extra depreciation generally, how much does it improve my after-tax position? And is the tax benefit influencing me to overpay? The harder questions to measure, we've talked about, what's it going to be worth in 5 or 10 years? And that's why it's so easy for people to make mistakes in this space, because the easy thing to measure is rent. The hard thing to measure is future capital growth. And that's where the big risk lies with property investment. So as it ages, could its rental premium shrink as it starts competing with established stock again? So like often you do see this established property that you compared it with that's selling for $100,000 or $200,000 yet less at the start, and its rent was obviously receiving was lower, but after 5 or 7 or 8 years, those two properties align on where their value sits and the rental income. But if you've bought new, you've been in that in the sliding scale of that outcome relative to the established property. So really, if it's new, you want it genuinely scarce features that future developments will struggle to replicate. That's really important, and a land to asset ratio that's going to hold. But it's harder to find new that is genuinely scarce and almost impossible to replicate. But that's the challenge when it comes to new most of the time for it to work.
Yeah, I've got one more question. What happens if this legislation is repealed? That's a question people have to ask themselves.
Yeah.
I mean, it's happened before.
That's
Yeah, I think
it makes the outcomes even worse if you've bought new for this reason.
Yeah. It depends what you buy, right? It's a different answer whether you're buying established or whether you're buying new. And then if the legislation is repealed, will it be, okay, well, we're going to grandfather anyone that wasn't qualifying for negative gearing, or we're just going to say from now on in, if you buy established, we'll allow you to negative gear. So the legislation matters. And a bit like you were talking about with the second-hand property, there's precedents in tax legislation from 2017 that said there are people that as a business will build apartments and sell them as tenanted assets. So the ATO gave some provisions for that, but that had to be happening within a 6-month time period, and it had to be undeducted assets. So the developer couldn't be claiming depreciation deductions and then the new purchaser buy it within 6 months with a tenant in place. Those assets would be considered secondhand. And even if you were renovating a property, the ATO said, well, if you stay there overnight while you're renovating, it's fine. But if you stay there for a couple of weeks and you're using the plant and equipment items like the floor coverings and the window furnishings and the kitchen appliances, they'll be considered a second-hand asset and they will be undeductible once that tenant goes in. So the way that I think new builds are a weird part of this legislation, and it will be a bit unusual if it's repealed, is I was sort of trying to come up with a bit of a term, and my AI helped me to sort of zero it into a non-transferable premium or a non-transferable benefit, right? So the benefit of buying a brand new property is the tax treatment, right? But it's non-transferable. So to the next person buying it, you can't give them that benefit. So you've paid a premium for it. So for an investor that pays a premium, that will be worthless if that legislation is repealed to a major extent. But also, it is weird when, Cate, as you shared, there's a huge cohort of first home buyers that buy new, but now they're competing with investors who want that premium. Now, that premium doesn't matter to the owner-occupier first home buyer, but they're having to transact in an area where competition for that stock will have heated up. So that just is more evidence that this is poorly thought out legislation. But, on top of the investor demand, it's the huge policy risk of it of changing, the non-transferable benefit. And I think we do need to zero back in on the fact that we've got already a huge shortage of trades. Construction cost data from the international conflict, the war in Iran, has only really just started to trickle through. We just saw an increase in the Cordell's construction cost index, and it was actually relatively flat in terms of growth. It was modest. We just saw that huge uptick during COVID, and then it was like lowest rate of growth for 20 years in materials, at least. Now with the war in Iran that's continuing to go on, and I think the markets are going, okay, well, we're not taking this glass half full approach anymore. Diesel costs are a huge component of construction with materials like PVC piping and adhesives and fixings, but also just the transporting of materials, both internationally and domestically, and the construction plant that is used on site. So there's all sorts of problems in the new build space.
We're doing some feasibilities into building some new refineries, you might have seen in the last couple of weeks.
Yeah, funny what a petrol shock will do.
Yeah.
If you had to pick who comes out ahead and who gets hurt the most.
Yeah, like, so the big winners, so the people who win above people who just make really good decisions, are those who buy, you know, the same old stuff, quality established property, or that really bespoke, scarce new property, but while the market is correcting, before the next rate reduction and before any tax laws are repealed. They stand to win big in capital growth. They stand to win big in rental increases over the first few years. I think upgraders have a great opportunity at the moment. You know, the best time to upgrade is in a falling market because the gap shrinks between the two of your existing home and the future home. Any homeowners who are able and, you know, actually work through the strategy, firstly, they have to understand it and be aware of it, which I think a lot aren't, and then actually make it work for them, that turn an existing home into a negatively geared investment property, and then buy another, whether it's an investment property, home, or actually even go and rent for a period, but make the most of that loophole, if you like, which obviously isn't a word we love, but turning their existing home into a negatively geared investment property. And the biggest losers are basically anyone who's purchased in the last year or two, and especially the first home buyers who've purchased at record numbers off the back of the most grandiose government incentives in history. And so we've had first home buyers buy in larger numbers than ever before, and then they've had the rug pulled out from under them. And as we've talked about, a lot of these buyers could go into negative equity. Some already will be. So those people who've done what the government's incentivized them to do are, in the short term at least, going to be the biggest losers, particularly if they need to sell.
Yeah, so there we have it. I want to ask you this, Mike, and I'll swivel back to Dave as well. What impact do you think this will have on people's investment plans and strategies going forward regarding property?
Well, I think it'll be a tale of the haves and the have-nots, and that is probably a parallel with the winners and the losers. The winners are people that already have portfolios, are already wealthy. I think they will realise that, okay, there's a brief respite of lowering asset prices and lowered competition, and they'll take that opportunity to grab those assets. They might not be able to negatively gear that, but they could have a positively geared portfolio that brings that closer back to parity, and that's an option that's not open to other people. And I think really the losers are actually the people that this policy was allegedly intended to help. So first home buyers, right? So I don't think first home buyers even realize that they are losers in this, because sure, they get in and they buy their first property. Hopefully they're buying it now rather than the last little while where they got that 5% deposit, and we're maybe seeing 5 or 10% declines in the property market. But once you've
And we
got
know
that,
half of them buy new. Throw that into the equation too.
exactly,
Yeah.
exactly. And then once they get that, they get used to paying the mortgage, and they understand that it's great to own their own home, which it is, and they're trying to build wealth like their parents' generation did, they'll realize that door is shut. I mean, in the lead up to the budget, there was a lot of talk about first home buyers or millennials, and then the baby boomers who have got all of these assets that really needs to be redistributed some way. Well, that hasn't happened. They sailed off into the sunset with a grandfathered arrangement, and the door is shut for them to build their wealth in the way that their parents did. So, like, it fundamentally shakes the snow globe of how you actually invest in Australia, specific to property, of course, but all other asset classes with capital gains tax. So, gosh, like, yeah, I mean, there'll be probably lots of more episodes that we'll do, and of course, with Dave on the roster and his strategy first approach, there will be ways to do it. But I don't think anyone would argue that it's not going to be harder for this generation than it was for generations that preceded it.
Dave?
Yeah, look, I mean, that all makes absolute sense. Agree with what Mike said. I think if we sort of narrow in a bit in terms of, like, I guess, building a portfolio, if you like, the family home, and it's obviously something I've always talked about, it being the centerpiece, the big rock in the jar for most Australians, the most expensive asset that most Australians own. That's only going to be enhanced through these tax changes because of the fact you pay no capital gains tax upon the sale. So more people are going to be even more focused on building wealth through the family home. As you've touched on, Mike, portfolios will be smaller. People won't own as many investment properties as they used to. But, just to remind everyone, the 90% of Australians who own property, well, 90% of them own one or two properties. It's 70% who own one, 20% who own two. So that's going to, so it was already the vast majority of people who own property only owned one or two. But that might creep from 90% to now 93% or 94%. So, they'll probably, but people won't build the larger portfolios they used to. Look, there's been a fair bit of talk about commercial. I think it's a bit of hype. I think it's quite reactive. I think it's a bit of short-termism. I think residential yields are going to start to compete with commercial yields within a couple years from a rental perspective, and so that's going to die down. We can't forget the hurdles with commercial still remain, that obviously there's fewer commercial properties. Everyone needs a roof over their head. Not everyone needs a commercial property. LVRs max are 70%, so it's much harder to get into ownership. The cost of commercial properties on average are much higher. The rates you pay on loan mortgages are much higher. So, some people will.
You need much bigger. Servicing is lower because it's amortized over a shorter period. There's a lot that people don't know about commercial, and I think you're right. I don't like the word hype, but in this context, I think it's accurate.
Yeah, I think the cottage industry of buyers agents around the country, that's grown so much over the last 10 years. And, a lot of those have switched to go, I'd now buy commercial, you should buy commercial. And so there will be more people who buy commercial for a period of time, but I don't think it's, I think that's more based around the businesses than the right strategy. For a massive group of property investors. Look, I think, I think there's some of the takeaways for me.
Yeah.
Yeah.
I'm conscious of time, and I want to shoot this to you, Mike. Beyond property, what's the flow and effect for the broader economy and household wealth?
Yeah, well, that remains to be seen. But property and property-related industries, I shared the data from the previous census, represented 27% of full-time wage earners in Australia. So a major decline in investor transactions going to flow to real estate agents, mortgage brokers, quantity surveyors like myself, conveyancers, building inspectors, property managers, valuers, developers, builders and trades, finance and insurance, and one thing that we've talked a little bit about that I think we'll be talking more about is state government stamp duty revenue. That'll have a huge impact. Lower transaction activity has a wide economic effect because every property transaction supports that chain of professionals and consumer spending. The policy will make it harder for Australians to build wealth. I think intelligent people will still do it. I was maybe a little bit too negative before, but it'll be larger cash reserves, less leveraged. It'll be slower, it'll take more time. But property's been principally one of the main ways that Australian households accumulate assets. So if you look at RBA's own data, it's like 70% of household wealth. So we're not going to be able to rely on that in the same sort of way. Government investment in social and public housing hasn't been sufficient to replace the role of private investors. So I think there's going to be a huge fallout from a lack of investment in that. And just broadly speaking, I've already spoken to some prop tech people that have observed people moving their businesses to New Zealand. I think there'll be less businesses started in Australia. I think the fact that we've changed the rules and broken a promise will impact international investment in Australia, which we desperately need. So I think if these policies stay in place, we are on our way to a recession.
Okay, well, that's cheery.
Sorry.
Yeah. I mean, look,
you asked.
I think, but I do. I think, as I'd said earlier, I think the flow-on effects to the economy have been underestimated, definitely by the federal government. I think they have no understanding of how much this impacts all the different areas that Mike's spoken about.
Yeah.
But if I look at some raw numbers, I think if we expect property values to grow at 2% less per annum, let's say, over, say, a generation, over 30 years, Australia, and 70% of Australia's wealth is in residential property. Rightly or wrongly, that's where it lies. So it's a really important part of how wealthy we are as a nation, the wealth effect, investing in businesses, consumer spending, etc. It's currently worth 12.5 trillion residential property. Now, if it grows at 6% over the next 30 years, it'll be worth 71 trillion. Now, let's imagine the Australian dollar still is relatively the same value across other currencies, etc. Our economy is still relatively as strong compared to other countries around the world. So therefore, that is real money. That actually makes a significant difference to the financial well-being of our country. It'll be worth 71 trillion at 6% growth over 30 years. If we only grow residential property at 4%, that will mean it's only worth 40 trillion. So that's 30 trillion difference, that 2% growth. I think this is the kind of thing that is completely underestimated in terms of the long-term impact on actually how wealthy we are as a nation. Like, we actually have a vested interest in our property prices growing at a reasonable level. So, I think that's would be a really big issue. Our real wages have fallen by 5.1% since March 2021, according to the OECD. So, on average, our country saw living standards improve by just 5% over that same period. So we're actually heading for the worst decade of living standards since 1910. So, there's pretty concerning. There's some concerning things happening in the Australian economy, and to lump these tax changes on top of our mediocre productivity that's been in place for about 20 years, actually, there's some really big, this just puts more fuel on the fire of what is already a pretty concerning economy for the last, extended period, which means in real terms, our living standards are falling and we're able to, our money doesn't go as far, basically, to put it in the simple terms. And, so there are some real concerns. We could even move into a place of stagflation in a
I think
worst
that's
case
the biggest
scenario.
risk. Yeah,
Yeah.
I mean, Mike's talked about recession, and that's horrible, but stagflation is very frightening when you've got asset values declining and cost of living increasing in tandem, and it's
Yeah.
what
And
governments.
rates don't come down because they can't, because
That's right, they
inflation's still
can't.
up, but our
Exactly.
incomes aren't growing. Yeah.
Yes.
Which is
So,
essentially happening on some level already.
well, it's every government's fear, and right now we're in that awkward situation. So I know this has got quite gloomy, but we did say that we'd be honest and bring some detail along with us today about, unpacking it all and sharing our honest thoughts.
Yeah.
Now, I've got one last question before we move to gold nuggets, and we are running short. We're literally 5 minutes off an hour. Tax policy, we've seen it swing before. If we cast our minds back to 1985 to 1987, we saw negative gearing changes announced and legislated, and then we saw them repealed about 20 months later. And there's a lot to learn from that, and I wonder how much has been remembered. And a lot of figures point to the rental issue. But do you think we could see this happen again? And obviously the question to ask is, what are the similarities between now and what happened in 1987, and what are the differences? Mike, I'll start with you.
Yeah, look, there's been a lot of people who've tried to look at the 85 to 87 experiment and generate a narrative that supports their view. And you can, whether you advocate for it or whether you think it was a disaster, there wasn't a broad impact. And we talk about it all the time because there is no national rental market. There's no national housing market, but it was repealed, I think, for a reason. So look, I think it is a little bit too far in distant memory. And I think this tax policy is less really about helping first home buyers, and it's more about being able to mop up the exorbitant spending rate of this particular government. I mean, we're up there in terms of expenditure to what we did during COVID to keep the country afloat and to keep people employed and businesses running. I think we desperately need a rethink, and stagflation can only really be solved by the other policy. We talk a lot about monetary policy, but the fiscal policy, what the government actually does. And, if rents are a big component of the CPI basket, they may have to go back and try and fill that public housing pipeline like they used to back in the day. But they've actually got out of that market, sold off those assets, and asked property investors to do the job. Property investors have maybe arguably done too good a job, and now everybody's angry at them. But I think they will find what happens if property investors aren't able to participate or won't participate in this cycle. So, yeah. Does that answer the question?
Yeah, it does. Dave, what's your take?
Well, look, so Keating obviously in the Labor Party repealed after 2 years. New Zealand changed their laws of limited interest deductibility for residential property after 3 years. But I wanted to share an example in France that hasn't been talked about quite as much. But I think it's actually very similar to what's going on here. It was called the Pinel scheme. It was introduced in 2014. It gave investors tax reductions of up to 21% of the purchase price for buying a new build property and committing to rent it out. The idea was similar to what we're doing here in terms of our incentives. So the numbers tell the real story. So investors were paying around $3,700 per square metre for new build property against an average of about $2,500 per square metre for established. So that was a premium of over 40%. So this was a report done when they looked at the failings down the track. So they found that after the typical 9-year holding period, so this scheme lasted for 10 years in France until 2024. After 9 years of holding the new property, it resulted in a capital loss on average of about 16,000 euros. Once the price gap between new and established property was factored in against the tax savings. So they found it didn't meet its objectives, but the government lost 7.3 billion in tax revenue by putting in place these incentives. It didn't fix housing supply. The auditor couldn't even say how many more new homes had been built. It thought it was negligible, and they found that what happened was the new homes tended to go up in areas where there was moderate housing pressure rather than in the areas where there was the acute shortages and where they were needed most. They actually also found in the end that the average annual return on these properties from a yield perspective was actually less than for established properties, because the low quality of the properties that were being built and that people purchased. And so they were typically taking a 15 to 25% discount on the resale value against what they had originally paid. So all in all, lasted 10 years, didn't work at all. The people who invested in it came out much worse, and they canned it in December 2024. It's called the Pinel scheme.
Interesting.
Nice one.
Wow. Well, we have hit our rev limiter on the clock. And there's so much more we could chat about, but I know that little snippets come out in all of our apps. This is pretty topical. I want to thank you for prepping all of these questions, Dave. They're really good, meaty ones that I've enjoyed unpacking. And for our listeners, whether you're a homeowner, an investor, or you're trying to break into the market for the first time, if there's one thing to take away, it's that these changes will play out over the years, not months. So don't make decisions in a panic either way. But stick around, our gold nuggets are coming up, and I've got one more question for us to unpack in our nuggets. A gold nugget question for someone trying to make a decision right now, buy, hold, or wait. What would you tell them to do? Mike, I'll start with you.
Now it's time for us to go mining for our gold nugget property tip of the day.
The best time to buy was yesterday, and I made the joke that was only more true on the 12th of May 2026. I think I spoke to a buyer's agent yesterday, and they said all you get from sitting on the fence is a sore bum. And I think that's a good way to think about it, right? We're not building housing fast enough. We're still growing as a population, mostly through international migration. And we're no closer to solving the hurdles that we set out to solve when that 1.2 million homes announcement was made over 3 years ago now. So as long as you understand the negative cash flow position of an established asset, if you're buying it, as long as you understand the premium you might be paying for a new build, I think property will still be a good investment. I think it's still better than any other asset class in Australia. So this is a fearful opportunity, and sentiment is in the toilet, but I firmly believe there'll be a lot of people saying that they wish that they bought in the back end of 2026 in 5 years' time.
My gold nugget is you've got to think about what will work for you, and cash flow is everything for investors. So the situation that we're in, it is what it is. Could it change? Yes, it could. Things could be repealed or changed. But I think when it comes to waiting, none of us know how to time the market, not the best of us. The economists couldn't tell you. The only thing we can tell you is through the rearview mirror. I can then stand back and pinpoint the times when it would have been a good time to buy. What I will say is that 3-4 week period after the announcement felt really dire. I think that was the best time to buy, but conditions haven't markedly improved since then. So it still remains, in a buyer's lens, a good time to buy. That's why we call it a buyer's market. I think the critical thing is when you do decide to buy, make sure it's for the long term. So the cash flow has to work and the growth drivers have to be really attractive. So you've got to think about location, think about floor plan, think about the outgoings, everything that stands a property in good stead. That's what you should be thinking about.
And look, and thanks to our listeners for listening through this episode. I just feel like it's been such a big topic, obviously, and so it was one I think deserved us to fully unpack all our thoughts around it rather than sharing bits and pieces across multiple episodes. So hopefully our listeners have enjoyed this episode, and I've enjoyed talking it through with both of you. Look, just echoing what you both said, the best times to buy are during the greatest market recalibrations or falls. Once COVID hit, the early stages were the best time to buy. During the Banking Royal Commission and leading into the election in 2018, which Bill Shorten would look certain to win and was saying he was going to abolish negative gearing. Hindsight, that was a great time to buy. During the GFC, proved to be a great time to buy. And there's been various other dips and examples of this. Like you've both sort of touched on, you need to be even more focused on cash flow outcomes of the investment. But in essence, if you're buying an established investment property, the maths is simpler now. You don't need to know the tax deductions on your interest because that's out of the calculation, because you actually have to cover that cost now. So at the end of the day, it's still what is the shortfall you need to make up each month, and work backwards to work out what's the right price point for you. Like the maths, like what determines the price point that's right for you hasn't changed. You've just got to know your own cash flow to start with, which a lot of people don't. Mortgage strategy, still is very important to optimize and preserve tax deductions. Having a smart risk management strategy around your mortgage, your buffers, insurances. It's the same stuff, sharper focus perhaps on holding quality assets for the long term, and probably, less speculation because it's perhaps higher risk. We're probably going to have smaller portfolios, as I've touched on, but I've always said you only need 2 to 5 properties, plus super and some other investments like shares or businesses, and you're going to be doing pretty well in retirement. And a clear plan, again, like I've always said, for your long-term home, which is usually big rock in the jar. So, there's not too much that changes, really.
Really well said. What a huge episode today is. And listeners, thanks for bearing with us. We hope that you got a lot out of it. I look forward to seeing you guys same time next week.
Thanks, guys.
Thanks, guys. See you next week.